Going to look at the different methods for estimating uncollectibles. So first we'll look at the percent of sales method. And so just to quickly recap, we have already determined what the adjusting entry looks like. So we already know that we're going to debit bad debt expense and we're going to credit allowance for bad debts at the end of the period to match the expense to the revenue it generated. But how do we determine what that number is? And so we're going to look at those different methods. First one being percent of sales method. And so it computes bad debt expense as a percentage of net credit sales. And some companies will elect to use all sales rather than net credit sales. So you just need to be aware of what the strategy and the style of that company is. And this is referred to as the income statement approach because of using sales, which is obviously reported on our income statement. The percentage itself is going to be the number that's determined by doing an assessment of historical patterns, and then, like I said in the previous video, taking into consideration other things, such as, you know, like if we've made a change and we're no longer extending credit to our worst customers, then maybe we anticipate that percentage to have improved from last year to this year. So that's where the percent comes from. So we have this example where we use the percent of sales method. The past experience suggests that it's 0.5% of credit sales will be uncollectible. And we have net credit sales of $60,000. And so you can see the calculation then of bad debt expense would be net credit sales times our estimated percent. In this case, 60,000 times 0.5% gives us $300. And so then our adjusting entry at the end of the year to recognize bad debt expense would be the debit to bad debt expense and the credit to allowance for bad debts for $300. And so then after posting the adjusting entry, we can see how the T accounts are updated and just see that on the income statement, we have the bad debt expense of $300, and we also have on the balance sheet the contra account, the allowance for bad debts for $300, which has been updated and will reduce our accounts receivable accordingly to present the net realizable value. So alternatively, we could use the percent of receivables method. This is a balance sheet approach, and because the accounts receivable is an asset, which is reported on our balance sheet, that's why it's called the balance sheet approach. And so the percent of receivables method computes our bad debt expense as a percentage of accounts receivable. So this is similar to the percent of sales method, except the percent is based off of accounts receivable. And so the first step of the percent of receivables method is to determine the target balance of allowance for bad debts. So instead of just looking at net sales and multiplying it by a percent, in this case, we're instead going to say, what is our target balance for the allowance for bad debts account? And so that's going to be the ending balance of our accounts receivable times the percentage that we have used or determined based on our assessment of historical patterns and additional information. Then, once we know what our bad debt, our allowance for bad debt account balance should be, then we need to figure out how we're going to adjust that account to achieve the target balance. So I think it'll be easier if we see it in a T account. And so the problem tells us that we have an unadjusted accounts receivable balance of $6,375, and 4% of the accounts receivable is estimated to be uncollected. Currently, the allowance for bad debts account has a credit balance of $55. And so we can see in this T account that our step 1 was to calculate our $6,375 times 4%, which gives us a target balance of $255. So then we update the T account to put the balance of $255 and then work backwards to determine what the adjusting entry needs to be. So because there was a $55 balance, we only need to adjust it or credit it by $200 to achieve the $255 balance. So similarly, or I guess the exact same, the journal entry will still be a debit to bad debt expense and a credit to allowance for bad debts, and just our number is different because of the method of how we calculated it. I will say to star in your notes to be careful of this, because oftentimes students just use the 255 rather than taking into consideration what the unadjusted balance of the account is, and then obviously get the problem incorrect. Okay. So in this example, we're looking at the percent of receivables method. However, the allowance for bad debts has a debit balance. So the unadjusted balance is a debit balance. And all that means is that last year when we did an estimation, we underestimated. And so we used up the entire amount and then have gone into the debit side. And so in this case, we anticipate we have $40,000 of accounts receivable and 2% we estimate will be uncollectible. And so the target balance is $800, but because it has a debit unadjusted balance, it's going to be $950 credit to achieve that $800 balance. And so just be aware of what your unadjusted allowance for bad debt balance is and how you need to adjust it to achieve the target balance that you're working towards. And then finally, we have the aging of receivables method. And so it's very similar to the percent of receivables method, but instead we're going to group the individual accounts based on how long their receivable has been outstanding. So we're going to look at 0 to 30 days, 31 to 60 days, 61 to 90 days, and greater than 90 days. And then we'll assign a percentage to each category based on how long it's outstanding. So in that regard, it's considered more accurate because we're not just saying some percentage of all receivables. We're saying if you hit the 90 plus category, there's a very good chance we're not going to collect. But if you're still in the 0 to 30, the odds of us collecting are much better. So we're applying different percentages based on the riskiness or likelihood of us collecting. And so you can see in this slide an example of that. So we have all of our accounts listed, and then their balances are presented in this chart in the 1 to 30 days, 31 to 60, 61 to 90, and over 90 days. And then a total is calculated for each of those categories. And then a unique percentage is applied to each category. And so like I was saying, if you're in the over 90 days, the likelihood of those customers not paying is much higher. So we have a 90% estimated to be uncollectible. Whereas if they're still in the 1 to 30 days, it's a 1%. And again, that percentage will be determined by each company as an assessment of historical performance and other information that they have that applies to making the most accurate estimation. So then the actual process of making the adjustments is very similar to the percent of receivables method. So we'll start by determining the target balance for the allowance for bad debts, and then determine how to adjust the account accordingly. And so we can see in this slide that we again had an unadjusted balance of $55 for the allowance for bad debts are based on our aging of receivables chart. Our target balance is 185 in the lower right-hand corner. So we plug that in and then determine that we need to do an adjusting entry for $130. And so just quickly, this is kind of a comparison of the two different approaches. You might want to pause the video and write both of these down, or just make sure that they're in your notes so that you can refer back to them in the future.